We need to talk about one of my least favorite topics today, investor compensation and deposit guarantee schemes in Europe, something you need to be aware of. These are meant as the last line of defense for depositors and investors when a financial institution, for example, a bank or a broker, fails and is unable to return our money, or even worse, our shares in stocks or ETFs. And while the deposit guarantee for banks in the Eurozone is pretty straightforward at 100,000 euro per depositor, the investor compensation scheme, meaning the amount that's reimbursed if a broker were to commit fraud or otherwise lose your shares, is ridiculously low at only 20,000 euros in most EU countries. Now, since your assets at regulated brokers are strictly segregated and simply held for you, you only need this protection if there is fraud involved and your shares were mismanaged or never purchased in the first place. But even still, 20,000 euros is just insanely little protection against this nightmare scenario. This is especially shocking when compared to US-based financial institutions, where banks have a $250,000 FDIC deposit insurance, 2.5 times what we have, and your shares are SIPC insured up to $500,000 per investor, which includes cash on a brokerage account up to 250k. This means the US investor protection is 25x the protection in most EU countries, which is just crazy to think about. How can anyone possibly justify a massive difference like this? As you can see, this is a very uncomfortable topic to discuss and look into, which is probably why you don't see a single European finance YouTuber ever talk about it. But we're going to do that today because it's important and shouldn't just be swept under the rug. This video is not meant to alarm you or to stop you from investing to reach your financial goals. I'm just hoping to shed a bit of light on this topic and to discuss some options to minimize this risk as much as possible. Who knows, if enough of us complain, we might even be able to see some positive changes in the coming years. Before we get right into it, gently tap the like button so we can increase the number of people we reach with this information. And if you'd like to support me, feel free to use my links in the description below to what I consider to be the best and safest low-cost brokers in Europe. I'll of course tell you my reasoning for that later on as well. So let's take a step back and talk about the deposit guarantee first. When you deposit money at a bank in the Eurozone, your money is protected up to 100,000 euros by the bank deposit guarantee in that country. The bank itself is legally allowed to lend out or otherwise invest your funds while they're sitting there and to generate income from them as long as certain reserve requirements are met. Since this is not risk-free, banks can default on their obligations to their depositors. A bank run, which occurs when a large portion of its customers want to withdraw money at the same time, can also drive a bank into bankruptcy very quickly. Just look at what happened in 2023 to Silicon Valley Bank in the US and Credit Suisse in Switzerland. As a result, the bank deposit guarantee protecting up to 100,000 euro per depositor is very important. Okay, but now let's get to today's main topic, investor compensation schemes in Europe. First and most importantly, when you're investing into ETFs, stocks or other securities using well-known, strictly regulated brokers like Interactive Brokers or Trade Republic, my two personal favorites, your shares exclusively belong to you. That's because the broker is simply acting as an intermediary on your behalf, but you retain full ownership of your shares. Since your assets are segregated from the broker itself, this means your investments cannot be touched in case of bankruptcy and would simply be transferred over to another brokerage account of yours, no matter if we're talking about 20,000, 100,000, a million euros or more. This is the major difference compared to bank deposits. One risk worth mentioning in this context is when share lending is involved, for example with the two brokers DEGIRO and Trading 212. Even though your shares are lent out against collateral, there's still some counterparty risk in case both the broker and the borrower were to go bankrupt at the exact same time. Now, since you want to ensure that your assets are properly segregated and recorded with you as the beneficial owner at all times, I would also prioritize brokers that are monitored by strict regulators. For example, I personally feel safer holding my long-term investments on a broker that's based and regulated in Germany by the BaFin compared to one that's based in Bulgaria and regulated in Cyprus by the CySEC, for example, which mostly handles brokers that deal with CFDs and leverage. Just to be clear, I have nothing against Bulgaria and Cyprus, I love both of those countries. Their regulatory authorities simply wouldn't be my first choice when it comes to ensuring the safety of hundreds of thousands of euros worth of my investments for decades. Next, your broker's finances provide you with an additional layer of protection in addition to asset segregation. This is where Interactive Brokers stands out. With over $14 billion in equity capital, 10 billion more than it needs according to regulations, a highly profitable business, a good credit rating by Standard & Poor's, and additional insights into its financials due to it being a publicly listed company in the US. Not only that, all client assets which are held in segregated accounts are reviewed every single day internally to make sure all records match, and additionally once a year by an external independent auditor. And apart from the default €20,000 investor compensation in Ireland, some investments are actually protected up to $500,000 via the US SIPC insurance if they're custodied with its US affiliate IB LLC. Sadly, I wasn't able to easily find out what this applies to, but I could imagine this relates to US stocks, for example, which I know many of you hold as well. Meanwhile, Trade Republic, my personal number 2 broker, which I also use to earn 4% interest per year on my cash reserves secured by a €100,000 bank deposit guarantee, has now become profitable as well after a strong focus on growth over the past 5 years, which turned it into Europe's largest broker with over 4 million customers and €35 billion in assets under management. Since Trade Republic is backed by some major investment firms like Sequoia Capital and Peter Thiel's Founders Fund and has large equity reserves, I have zero worries about its future or my investments here either. The fact that they've now received their own full banking license, something very few other brokers have, adds an additional layer of trust as well. ETFs, stocks or other securities you hold on Trade Republic are handled by HSBC, the largest custodian bank in Europe with over €2.6 trillion in assets, and remain your property at all times as they're never lent out, which is also where you can transfer your shares in or out anytime for free if you ever change your mind on the broker you want to use. You can do the same with Interactive Brokers, by the way, something I did in a previous video which I'll link right here. Even still, let's assume every safety mechanism so far fails. For example, in the case of fraud, if your shares were never purchased in the first place or otherwise mismanaged. This is pretty much impossible with well-regulated brokers since there are strict internal processes for handling and reviewing customer assets on a regular, oftentimes daily basis, and a constant exchange with regulators to verify that all assets are custodied correctly in the correct amounts. Even still, for now, let's assume the worst. Your assets can't be found, or at least some of them are missing. And to make things worse, the broker does not have the capital to reimburse you for missing shares, meaning the second layer of protection, the broker's own capital, failed as well. This extremely unlikely scenario is the only case where you have to rely on the investor compensation scheme as your last line of defense. And here's the shocking part. Even though it should never be needed if you picked a trustworthy, strictly regulated broker, the investor compensation for all of your shares is limited to only €20,000 in most European countries. Yes, that's 5 times less than the 100k bank deposit guarantee, even though we could be talking about people's entire retirement funds here. And compared to the SIPC insurance in the US, which protects investors up to $500,000 each, the difference of 25x just makes you want to cry. I don't know how else to put this. To make things worse, the investor compensation amount of €20,000 hasn't once been adjusted for inflation since 1997, which would at the very least raise it to €35,000 today. There were some proposals to update the protection limit to €50,000 in 2010, which is still way too low, but the proposal was ultimately withdrawn in 2015 as it wasn't endorsed at the EU level. In my opinion, it makes zero sense for this protection to be lower than the bank deposit guarantee in the first place. In fact, it should have been higher instead, just like in the US. That's because we're talking about people's long-term investments and retirement accounts here. This gives me the impression that the EU and most of its member states treat us investors as if we were mindlessly speculating on risky assets and are not worth protecting as a result, compared to the average Joe just keeping everything in cash on their bank account or spending it all every single month as a good citizen should, am I right? In my opinion, this urgently needs to change and this topic deserves to get more attention. Maybe some of you can help me with that by sharing this video and gently tapping the like button. Okay, in all seriousness, does this mean you should be worried? Or should you open additional brokerage accounts whenever one of them reaches €20,000? No, of course not. That would be ridiculous. Just make sure you pick a reputable, strictly regulated broker, for example Interactive Brokers or Trade Republic, and your risk of losing any of your shares should be as close to zero as possible, even if they were to ever declare bankruptcy. If possible, I would avoid brokers that lend out any of your shares by default, since that introduces some counterparty risk and can mess with asset segregation, which is essential in the case of bankruptcy so that you get all of your shares back. You should also pick an option that allows you to transfer your shares to another broker anytime so that you're never locked in case you see some developments that you don't like. Generally speaking, I think there's nothing wrong with adding a second or even third low-cost brokerage account once your investments reach a certain size, even if it's only to make you sleep a bit better at night. If I had to pick a single broker to keep all of my investments on, It would definitely be Interactive Brokers due to its long history and financial strength. But luckily I don't have to stick to a single one. As a result, the investment portfolio I share with my wife, which recently crossed 300,000 euros, is currently spread out across a total of 4 brokerage accounts. The Austrian broker Flatex, where we started our ETF investment journey back in 2017, Trade Republic, which we additionally use to earn 4% interest on our cash reserves, Scalable Capital, and lastly, Interactive Brokers, our largest account. 4 is definitely overkill though, so I wouldn't recommend copying what we're doing. It just so happens that we accumulated a few brokerage accounts over the years, which luckily all come without account fees. I'm not planning on adding any more though, even if our investment portfolio were to grow beyond €500,000 or more. So, as you could probably tell throughout the video, I'm quite upset about the situation and I wish it wasn't something I need to talk or even think about in the first place. If we were in the US, we wouldn't have to waste any time on this since all of our accounts will be protected up to $500,000 each, while the €20,000 limit in most EU countries is just a massive joke in comparison. Since my wife and I are getting closer and closer to reaching our goal of being able to retire early in a few years, and ETFs are the main pillar of our investment strategy, this is something that's on my mind from time to time. I really wish it wasn't, and hopefully this changes over the coming years. Until then, the best we can do is to pick reputable, strictly regulated brokers to reduce the risk of ever being in a situation where we need to rely on investor compensation schemes in the first place, and to diversify over 2 to 3 different brokerage accounts as our investments grow in size. Alright guys, this was a really rough topic to talk about. I hope I didn't take this too far, as I would hate for any of you to now be discouraged from investing to reach your financial goals. I just wanted to shed some light on an uncomfortable topic that seems to never be openly discussed anywhere. Hopefully we're able to see some changes by making more people aware of it. Before I take off, don't forget to gently tap the like button and to subscribe if you haven't yet. You can find the best low-cost brokers for ETFs I mentioned in the description below, which is a great way to support me if you'd like to. Thank you guys so much for watching, have a wonderful week, and until next time.